The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, let's take a look at midweek market action on Wednesday. Pressure in soybeans was a tough day there. Corn, though, found some green on the screen. Wheat futures off the lows of the day as well, and a good rebound in cattle futures, and hogs extended their gains too. There's plenty of stuff swirling around these markets that we need to take a look at. Joining us here on the show as we're spending time at CattleCon 25 in San Antonio. He's at his home office in Kansas. Mike Zuzolo with Global Commodity Analytics is with us. Mike, good to catch up with you again this week, my friend. Are you getting ready for that Chiefs Super Bowl Sunday coming up here?
You bet. The three-peat, and we're going to see how we can do here and see if we can't put some records in the record books and give Coach Andy Reid something that he definitely deserves. He's a great coach, one of the best of my lifetime, I think.
I know we're prepping some barbecue to watch the game on Sunday, so I'm looking forward to that. You know, I've always said this. I feel like Monday should be a national holiday the day after the Super Bowl because none of us are going to want to look at the markets or work that day, but we will. But you know how that goes, Mike.
Yeah.
Hey, let's dive into the markets here a little bit. And I want to start with your 1,000-foot view perspective. Plenty of volatility the last several days. What are you kind of keeping an eye on right now?
The biggest thing I'm keeping an eye on, Jesse, is the market reaction, whether the tariffs are red hot news and the market's worried about zero demand, or whether they're breathing a huge sigh of relief and turning the market into a risk-on mindset. And I think this is important, especially for quarter one and quarter two of this calendar year of 2025. You really can make a strong case of significant headwinds if Canada, Mexico, China don't work out in terms of the trade negotiations. And I'm still sticking with the first 100 days of President Trump's presidency for things to get worked out and ironed out, and we move into another level of potential demand upside when it comes to the dollar breaking to the downside. I still think that President Trump is not a disciple, but a very close follower and admirer of President Reagan. And his trade policy is his foreign policy. Reagan's was very similar to that as well. And Reagan really broke the dollar in 1985 at the Plaza Accord. He did it with Japan's Japanese yen, and because it was way too weak and the dollar was way too strong. And I see China very similarly right now as what Japan was back in the 90s and mid 80s. So I feel like with you look at it like that way, you could have a very strong demand push to the upside and another move to the upside in the agriculture commodities if the trade relationship gets ironed out quickly. Otherwise, if it doesn't, I could see a real big headwind in terms of demand, and we have to rely solely upon the weather from there on out. So I think you really got to get yourself in a position mentally and a position from a risk management standpoint that you really want to be able to have some back doors after you reach profitable levels as far as hedge and then defend those hedges and know how to do it.
Okay. All right. I know some interesting correlations you got for us here today. Let's talk corn and gold. And walk me through what you're watching here. This is an interesting correlation, I feel like, between a main grain and a main outside market to watch.
Yeah, in the old days, some people would call corn the yellow gold, and as far as the agriculture gold, and for good reason, because of inflation. And this goes to what I just said for the last several minutes. I really want to put the pencil to, because I don't like just like pontificating and saying things without having something to go on and be able to trace and track and have some true analysis. And I think this is where what I've seen this week specifically, Jesse, whether we've had tariff fears or easing worries about tariffs, gold continues to make new record highs. And that puts me in the opinion now that it's not just a safe haven, it's an inflation safe haven. And that's because the Fed is trapped. It really can't raise or lower rates right now because of the economic conditions and the sticky inflation that we have right now. It can't cut rates. And I think the trade's picking up on that. I'm also hearing about the idea that there's rotation coming out of the U.S. stock market, hedge funds specifically, moving money, and potentially, I think, moving them into the commodities and moving them into gold and into corn as well. And so I think the other side of that is President Trump's tariffs. They are inflationary. If we have inflationary pressures from tariffs, I think the gold and the raw commodities, the hard assets, are going to be wanted more in investors' portfolios. And like I said a minute ago, if we have very smoothed out trade tensions, and all of a sudden China is willing to buy more agriculture products, with which some news outlets are pushing this week, it would suggest that we've got another demand level that we could possibly reach and head to, with the United States being more of a favored buyer as far as what China looks at. So I really want to keep track of this gold corn relationship now that we're making record high after record high in the gold market.
And you have a correlation chart here that looks at this as well. I love these charts when you send them to me, Mike, selfishly, because I think they're neat to kind of look at just how markets like these two kind of play together.
You're one of the very few media people that I share this with, because you appreciate it, you understand it, and you give me a chance to explain it as well. But what we're seeing on an 8-week basis right now, and this is the neatest thing about this chart, is there's a lot of minuses and pluses. There's a lot of swings on an 8-week basis in the relationship to corn and gold. So you can't get too caught up in this. It's a supporting piece of analysis, I would call it. But we've gone from about a negative 50% price relationship on an 8-week basis for lead month corn against lead month gold futures to now a 0.95 or 94% positive relationship. We're back right where we were early last fall, when the gold was running higher and the corn was trying to rally with it, after getting through the nervousness of that August time period and putting behind us those 2008 worries and fears that we had during that time period. So it is a big wake-up call that they're moving close to 95, 94% positive in terms of price relationship right now.
We saw a good corn sale to Mexico on Wednesday morning. I wonder if that maybe helped out the corn market a little bit. We also got the latest EIA data, and let's talk about that as well. Just what are you seeing when you take a look at some of the latest ethanol data, distillates, et cetera, Mike?
Yeah, ethanol supplies are still way too high. Margins are coming back a little bit. I think they're back in the green at this point after the last week or two. The big thing that I want to watch now is, we've talked a lot about the Middle East and history and how crude oil prices tend to help support the grain markets on that same vein of inflationary pressure. And so instead of what we're seeing right now in the energy market, is oil is falling, and it's actually made new monthly lows, and it's actually getting close to testing its 2025 lows at this stage after Wednesday's market. And this is after President Trump says the United States is essentially going to buy the Gaza Strip and most Middle Eastern countries like Saudi Arabia. News reports out of Europe and Asia are saying that Saudi Arabia is not on board with this. So I have to ask myself a question: why is oil falling right now, when it really should be having more volatility and probably should have more upside price momentum, given the volatility in the Middle East that we're starting to go into? So that's point number one to watch out for. And this is why, because of the tariffs and because of this price action in the crude, we've seen a pullback in some of the energies here the last several months. I went ahead and recommended to clients and subscribers to lock in their spring diesel needs over the weekend, this past weekend, Jesse, because of the Canadian situation in terms of how much oil we bring in to refine. And this chart really helps seal the deal. When it came out on Wednesday, you can see in red the distillate stocks are heading towards fresh. They are at fresh 2025 lows, and they're heading towards some of the major lows from late 2024 at this point. We're losing supply when it comes to diesel. Prices are relatively low against the last 3 years. And I think it's a good piece of risk management and hedging to just get that locked down, because I think there's a lot more upside potential than downside as we go through this Mideast peace process and what President Trump's talking about.
And to that point, we've talked before about crude being the canary in the coal mine. Do you think it still kind of is the case here in this broader market trade, Mike?
It's a lot harder because of Canada and the fact that we take on in the Midwest of the United States so much. I mean, 4 million barrels a day plus, and almost all of that comes from Canada for Midwest refineries to crack and refine into crude or into unleaded and diesel. And so I think the crude oil has more of a weight towards the tariffs as far as a sharp increase in prices, but I still wouldn't discount what's going on with Russia and what's going on with the Mideast. I put all three of them at probably in the category that there'd be a lot more likelihood of a price spike to the upside, given those three factors.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Let's talk weather. Let's talk South America, and let's talk soybeans. And let's start with the weekly soybean chart. And obviously, beans were the biggest loser on Wednesday's futures trade, down 10 to 20 cents. We've seen a bit of a rally, though, after all the tariff off again, on again, pause, etc. So when you take a look at the soy chart right now, what stands out to you, Mike?
Well, I've got quite a few clients who are rightfully chomping at the bit to get some more hedges in place and get cleaned up on our 24 sales. I'm very happy with that because I think they're on the right track because we are harvesting in Brazil. And I think if you had to pin me down and say, why didn't we go through this 52-week moving average on this chart and get back towards that $10.90, $11 level where that wedge breakout pennant or point on the wedge kind of is where the flat line is. Why aren't we getting between 11 and 11.30 where some key resistance levels are? I think it's because we are harvesting in northern Brazil. And quite honestly, Jesse, numbers are not coming down in Brazil for production. We're still hearing 168 to 171. And now we're in the heart of really making the crop at this stage of the game. And so beans are going to be more difficult to work with. I still feel like, though, if it's the weather, and that's what some of the market commentators were talking about on Wednesday, that better weather in Argentina did it. We'll talk about that here in the next few minutes. I'm not on board with that yet. I'd also say that we just made a new 3-month high in the Brazilian real this week against the US dollar. I want to see how that plays out. So I'm trying to be patient with this weekly bean chart, but I'll have to make some moves for clients if I don't get what I need by Friday's close.
Well, let's talk about that weather, and you shared a precipitation map of South America with us. And I mean, I've heard a lot of different cases about the overall situation. I know Argentina's dry, for instance, and has been pretty dry. So what's the latest you're hearing in South America, Mike?
Yeah, I hear the same thing, and I'll even make it a little bit more of an extreme point. Is this square that highlights the Argentine crop belt for the last 7 days? They did get more rain in the northern half of that crop belt, very needed crop saving rains, but the other half did not get anything. And so then if we look at it from a standpoint of the last 60 days in terms of where we're at, precipitation versus where we should be, which is the next map that we have for today's video, it shows pretty clearly that we've got a situation brewing that there is no going back for the crop as far as getting the production back. So I went down to 48 million metric tons on corn this week. I'm below USDA's 52 million metric tons on soybeans. You can see in this Argentine cornfield that came courtesy of Reuters earlier this week on a video they put out, this is looking more like 2012, and this is what we talked about several weeks ago.
It's quite an interesting situation that we're kind of waiting to let a lot of this play out. And I think about up in Brazil as well, challenges there with some rains and more. And it's that time of year that we have to kind of let things settle out. But more and more as we go along, the issues seem to be there in South America.
Yeah, I mean, the thing that I always go back to, Jesse, is you've got roughly 50 million metric tons of corn and beans in Argentina, but you've got 170 potentially in Brazil of beans and 125 potentially of corn. And so it's a lot harder to bring South American production down if Argentina is the only one doing it. And so I think there's about a 2 to 3 week window right here where we could trim the Brazilian crop enough that the Argentine supply problems become a reason to justify another leg higher. But I'm not giving up on the idea, that the long held idea, that the wheat and the corn can go up together and pull the beans up with it as we get into the later part of February. But like the cattle market, I would say the clock is ticking for the bull when it comes to the soybeans.
All right. You mentioned the cattle market. Let's go over there. Let's take a look at the monthly feeder chart first. And futures, we kind of pulled back Monday, Tuesday. I wondered if that was tariff related, if it was cattle imports from Mexico resuming related, a combo of things. What are you watching first when you look at the feeders right now?
I think it was a combination of things. I think you hit it on the nose. And I think you also had a situation where Wall Street took a real big hit, but it came roaring back. The dollar went sharply higher, but it started to go back and break lower again. And I think it hit something like a 22-year high against the Canadian dollar earlier this week. Now it's threatening new monthly lows at this point against the Canadian dollar. And so I feel like in the short term, we're in a situation where if the cash is still 210, 209 area for negotiated cash, and the Fed futures were at around 202, and the soon-to-be April futures for live cattle were down around 197, 198. There's about a $12 discount in April compared to the cash market, if not a little bit more at one point. And so it made sense to me that if the feeders were going to break and break hard and essentially put a top in place here, it had to be signed off on by the fat cattle market. The other thing that I'll bring up, Jess, is we talked about this last week, is the cattle on feed report and how it was, we're only down about 1% in on feed numbers, still holding that roughly 12 million head on feed. The inventory report at the end of last week confirmed that. And so we still have this major difference and disagreement year-to-date slaughter right now as of the last week of January. First week of February is down 9% versus 2024 for the same period. But these inventory numbers and these big USDA reports are saying nothing to worry about. We're only down 1% right now on cattle on feed. And so something's got to give. And that's, again, supports the idea that the fat cattle are in the leadership position here in the short term. So I was watching the yellow trend line on this monthly feeder cattle chart, because you take that out and you're going to threaten your 2024 highs. And right underneath those 2024 highs are the 2023 highs. This is a beautiful chart. I take this chart at very face value on a monthly basis, because you've got a really nice looking chart that you can, I think, support ideas of where we could go in terms of downside potential. And if you break to 65, 270 area that we just tested, wouldn't be hard to go down to 250 and test those 23, 24 highs.
Good thoughts there. One more chart to look at, the Feb live cattle daily chart, and thinking about fats right now. We've been talking about this, getting above that 2 handle, but where do we go from there? What are you watching right now in fat cattle?
Yeah, I got some puts on from a few weeks back when it comes to the fat cattle market, and watching this trend line, especially because February is the key. It's the cash market. And if we lose 202 in that recent low we just made on Tuesday, I'm going to guess it's because the cash market's buckling, because packers are not coming to the table because their margins are so bad. But something happened on Wednesday that I think may make them refigure their calculus. We've got winter weather coming back. We've got a snowstorm again and very cold temperatures again coming into mid-February plain states, especially on the both models. And especially if those things happen and those materialize, I think the packers may have to do what they did last month and come to the table and make the bargain and strike the bargain at that 210 plus level. So that's kind of what I'm waiting for. But I would not want to see this Fed fat cattle chart take that white dotted line out at all. That's the backbone of the chart. Could take you all the way back to 192, technically speaking, to the orange trend line. So that would be very negative for the feeders, because the fats have, as I said, been really holding up the feeders at this point.
Mike, always appreciate the analysis. Anything final you'd mention or reiterate to folks here today?
And the only other thing I'd say, Jesse, is we need to reiterate the idea that President Trump's economic tariff policy is one and the same in terms of commodities to his foreign policy. And I still talk to people that don't really get that yet. And I think it's really important you realize that he is willing to do some pretty out-of-the-box things, because he's got a different look to things that many presidents before him have not. But you can find a lot of similarities with Ronald Reagan and President Trump right now.
Mike, if folks want to reach out to you for some thoughts and analysis help and more, how could folks get in touch?
Globalcomresearch.com, and it's globalcom with 2 M's, research.com. Get a free trial or give me a call on the toll-free number.
Mike Zuzolo, Global Commodity Analytics. Always good to chat, my friend. Have a great week, and we will talk to you next week.
Thanks, Jesse. You too. And thanks. Be safe on your travels.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.